The war between the United States, Israel and Iran is being fought with missiles and submarines in the Middle East, but it is also being fought in trading rooms in London, New York, Singapore and Tokyo, and the economic damage from that second front is already spreading to every country on earth, including ones that have no military involvement in this conflict whatsoever. Here is the confirmed market picture as of day 6. Brent crude oil opened Monday at $73 per barrel, the price it was trading at when markets closed the Friday before Operation Epic Fury began. By Tuesday, it had surged to $83 per barrel, a rise of approximately 14% in 48 hours. During the same period, oil briefly spiked more than 9% in a single trading session, the largest single-day surge since the early days of Russia's invasion of Ukraine in 2022. By Wednesday, Brent was trading near $82, $40 per barrel, with front-month contracts holding elevated despite some modest pullback following Trump's announcement of political risk insurance for Hormuz transit. Goldman Sachs, which had estimated during the June 2025 12-day war that an extended Hormuz disruption could push oil past $100 per barrel, has not revised that estimate downward. They have reissued it. The mechanism driving those prices is not complicated. 20 million barrels of oil per day transit the Strait of Hormuz, approximately 1/5 of all oil consumed globally, and more than 1/4 of all seaborne oil trade. That traffic has effectively stopped. Vessel tracking service Kepler confirmed that tanker traffic through the strait has come to a near halt, with the limited vessels still transiting being primarily Iranian and Chinese flagged ships. 6 tankers have been struck in Gulf waters since February 28th. 2 crew members have been killed. Iran's IRGC broadcast a message on the International Maritime Distress Frequency stating the strait was closed and that any vessel attempting to pass would be set ablaze. Maersk, Hapag-Lloyd, MSC and CMA-CGM, 4 of the world's largest shipping companies, have all suspended Hormuz transits. Approximately 150 ships are anchored outside the strait, waiting. The insurance mechanism is the one most people are missing. Iran has not physically blockaded the strait with ships. It no longer has a surface fleet capable of doing so. What it has done is make the risk calculation for commercial operators impossible to underwrite at any viable premium. War risk insurance for Hormuz transit had already reached 6-year highs before the strikes began. After February 28th, the withdrawal of protection and indemnity coverage was effectively total for most operators. US law restricts Navy escorts to American-flagged vessels, which means the Trump administration's escort proposal, announced after Brent spiked 9%, after which prices eased somewhat, cannot solve the problem for the majority of the world's tanker fleet. The Rystad Energy chief economist Claudio Galimberti described the Hormuz situation as blocking the aorta of the global circulatory system. That is not hyperbole. It is a precise anatomical description of what a 20 million barrel per day choke point represents in the global energy architecture. The LNG picture is, if anything, worse than the crude oil picture. Qatar's state energy company, Qatar Energy, confirmed it halted production at its 2 main LNG export facilities at Ras Laffan Industrial City and Messaid Industrial City following Iranian drone and missile attacks on both sites. Qatar is the world's largest LNG exporter. Roughly 20% of global LNG supply transits Hormuz, almost all of it from Qatar. European natural gas futures jumped approximately 30% following the Qatar shutdown announcement. UK second quarter gas contracts were trading approximately 50% higher than levels seen at the end of the previous week. LNG tanker daily freight rates jumped more than 40% on Monday alone. The US natural gas price was up 5%, and while that is modest domestically, it matters because the US is the world's largest LNG exporter. Higher prices boost American producers, but raise electricity costs for European and Asian buyers simultaneously. The downstream consequences are already being felt in consumer prices. Jim Crane, energy fellow at Rice University's Baker Institute, confirmed the transmission mechanism simply: when shippers' costs go up, it is folded into the price at the pump that consumers pay in a market. US gasoline prices had already risen more than 11 cents overnight in the war's opening days. The increase is not immediate everywhere. It can take weeks for crude price movements to reach retail pump prices, but the direction of travel is unambiguous and is already reflected in futures markets. Stock markets globally took an immediate hit. The S&P 500 futures sank in early trading on the war's first day. South Korea's Kospi index fell 12% in a single session, its largest single-day decline on record. Japan's Nikkei, India's Sensex and European indices all dropped sharply. The flight to safe haven assets was immediate and significant. Gold, the Japanese yen and the Swiss franc all rose as investors moved out of equities and risk assets. Bond yields fell in countries where investors sought safety. The geographic distribution of pain is not equal. Asia bears the heaviest exposure. China, India, Japan and South Korea together account for approximately 70% of the oil that transits Hormuz daily. China has substantial oil stockpiles both on land and offshore, which is one reason why crude markets, despite the spike, have been described by traders as measured rather than panicked. The short-term disruption is being absorbed by inventory. The medium-term risk is what markets are pricing. If the Hormuz disruption extends beyond 2 to 3 weeks, those stockpiles deplete and a genuine supply crisis begins. Iraq is particularly exposed. It may face having to shut in oil production entirely if it cannot export through the strait. The Stimson Center confirmed that a serious Hormuz disruption could remove 8 to 10 million barrels per day from world supply, a number that no combination of emergency reserves, alternative pipelines or OPEC spare capacity can replace quickly. Saudi Arabia and the UAE have alternative pipeline routes, but analysts confirm they cannot handle anything close to the volumes currently transiting the strait. The OPEC dimension adds another layer of complexity. OPEC Plus retains approximately 3.5 million barrels per day of spare capacity concentrated in Saudi Arabia and the UAE, but as the Cape Layer analysis confirmed, a significant portion of that capacity cannot reach global markets if the strait remains inaccessible. The spare capacity exists on paper. Getting it to buyers in Asia and Europe in a closed Hormuz scenario is a logistical problem that spare capacity declarations do not solve. There is one confirmed winner in this disruption, and it is not America or Europe or Asia, it is Russia. As India and China pivot away from disrupted Middle Eastern supply, Russian oil, already deeply discounted to Indian and Chinese buyers under sanctions-era pricing arrangements, becomes the default alternative. The US Treasury Department confirmed this dynamic on March 4th by issuing a 30-day license specifically allowing Russian oil sales to India as tankers remain stranded near Hormuz. The United States licensed Russian oil sales to manage an energy crisis generated by its own military operation. That is the most precise single-sentence summary of the war's economic paradox, and it has not received the attention it deserves. The bottom line is this: a war launched in part to address Iran's nuclear threat is simultaneously generating an oil price shock, a global LNG supply disruption, a stock market sell-off across 3 continents, inflationary pressure on consumer prices in countries with no involvement in the conflict, and a specific benefit to Russia that the US Treasury is now actively facilitating speculating to manage the damage. The markets are currently betting on a short conflict. Every analyst with a published estimate agrees on one thing. If they are wrong and Hormuz stays closed beyond a month, the economic consequences will be larger than anything seen since the 1973 Arab oil embargo. The war is 6 days old. The bet is still open.